Hi, I'm James Dunn. Welcome to the Inside Network. Paul, welcome to the Inside Network.
Thanks for having me.
Wanted to start with a description of this asset class, distressed credit. Is it an asset class on its own or a subsector of credit? Just what kind of investments do you look for?
So we really think of distressed credit as part of the alternative asset class. You can think of it also as part of general credit exposure as well, but it's really a traditional alternative asset class that's developed over, say, the last 30 years or so. And what we're looking for in that is taking credit exposure or buying into existing capital structures, debt pieces of existing companies that have already been issued, in businesses that are having a dislocation or an issue. They're undergoing some kind of a stressed or distressed event. Mm-hmm. And that can be anything from a macro issue, a company slowing down because of a recession or an issue in their sector, or it can be a micro issue, something operationally going on in the company, a working capital or cash flow issue, a customer loss, an integration issue. Maybe two companies have merged and they're having trouble working out integration. So we're really looking for, in the end, companies that are having problems and taking debt exposure or credit exposure to those companies and helping them work through that.
So does it require an event like a downgrade or an actual default or just a perception that those events are becoming more likely?
So it depends. We really think of it in two buckets: stressed credit versus distressed credit. Stressed credits are companies that we make investments in where we buy into the debt capital structure, and we don't think the company is going to need to restructure or go through a formal bankruptcy process, an informal process, or a scheme of arrangement like you have here in Australia. And in those cases, they're generally driven by downgrades. Our credit rating agency will downgrade something from single B minus to triple C, and there's tremendous selling pressure when things get rated triple C for a number of structural reasons. Distressed credit are investments we make where we're looking to take control of the company through a formal restructuring process. And those generally, we call it going through the process the old-fashioned way. It's simply running out of money. The company can't repay its debt when it's due, can't make interest payments, or simplistically can't make payroll.
So can it be seen as an extension of high yield, where your universe starts where high yield names start to encounter difficulty?
So I would think of it in two ways. It could be the leveraged loan universe, which is fairly large as well. So senior secured bank debt or leveraged loan debt that's arranged by banking syndicates and sold to people who buy loans. Those generally tend to be secured by the collateral, the assets of the company, or high yield, which tends to be an unsecured obligation. There are distressed debt investors that play in both of those fields. We tend to be more focused on the loan universe because we like security. We like to have the collateral and assets that back the loans.
In Australia, where investors are probably, you could say, really only getting their heads around credit as an asset class and an investment exposure, do you feel that distressed credit is a whole new world, a very large step to take, or still seen within that credit exposure world?
So I think in my view, investors globally, and not just here in Australia, but are looking for yield in today's low interest rate environment. And if you put aside the events of the last couple of weeks in terms of coronavirus and other stressors coming out of Asia Pacific region, I think generally speaking, we've been in a very long period of low interest rates, and people are looking for ways to get more compensation, to take more risk, get more return. And so I think people have, in Australia, been open to it, and in other markets have been open to ways to move up the return spectrum. And this is another way of doing that. There are lots of different forms of alternative credit, and this is just one of those flavors. I think the market here is generally open to exploring it.
While we're on low interest rate environments, what does that do for your universe? Is the investment style something that requires more defaults? And if so, does a period of low interest rates lessen your scope to work with defaults or create more of them?
Yeah, so that's a great question, and it's pretty observant in that if you think about relying on interest rates to go up to increase distress in an opportunity or to increase our opportunity set overall, you'd be waiting a long period of time since we really haven't had high rates for the last decade or so. So I'd say I think of the distressed market in two buckets. One is large capitalization companies, distressed focus, versus small capitalization. We're over in the small cap market. But if you think about large cap distressed for a moment, it's been very quiet for the last decade. And that's because if you're a big, robust company, it takes a global financial crisis to really cause issues for you, or a sector issue. So retail would be an example of that, where Amazon came in and disintermediated the entire market. And so all of the retail companies, big and small, are having issues. Or energy, metals and mining. If you see oil go from $120 4 or 5 years ago down to 40 over the span of a couple of months, big energy companies are having issues. So you really need a sector hit or a recession to have opportunities in large cap distressed, which is part of the reason we don't like that space. We really like to play in the area that's much more small cap focused, sub $500 million companies, sub $100 million in EBITDA, very small lending syndicates at original issue, because that market tends to be driven by idiosyncratic everyday opportunities. Just simplistically, smaller companies get into trouble more often, more frequently, because they're simply smaller, less robust, less sophisticated. Capital structures are simpler, they have less access to the capital markets. So I think you're absolutely right that low interest rates have prolonged a bull market here in terms of, and a bad market for large cap distress. Small market's very different though.
What about distress in the sense of, is it a relative thing? Say, for example, if you've got a corporate that is downgraded from very high credit ratings to lesser, but is still investment grade. Is that in its perception and the market's perception distress, or is distress really meaning no, outside investment grade rating and going south?
Correct, it's the latter. So I think whether something's in that sort of IG space and move notches within there, that's not going to cause a very big issue. It's going to be measured in basis points. And then even if something is sort of fallen from investment grade to one notch below that into junk territory, so-called fallen angel, that's not going to really be what we're looking to do. We're really looking for those situations where there's a pretty identifiable issue. Debt that was issued at 100 cents on the dollar is now at 60 cents on the dollar, and it's likely the company's going to need to be restructured. You're going to need an operating plan to fix the company and a balance sheet plan to recapitalize the right side of the balance sheet.
So take me to that win-win situation where you can create in this field where investors get involved, and there's a new player, and the situation can be changed for the company and the employees and the suppliers because somebody like you is involved, and it's not just the banks. There's a different source of credit and somebody whose role is to come in and participate and be rewarded, but you add a whole new element to corporate difficulty.
Yeah, and I think that's a great question. In many ways, much of the credit market and people who analyze credit are very pessimistic and very conservative. The distressed business, in my view, is about, or strategy in our view, is about really finding diamonds in the rough and finding an opportunity where things can look pretty bleak at certain times. And in order to do that, coming into those situations, one of the first things we think is important is developing a dialogue with management, and most of our companies are private equity owned and the private equity sponsor. Nobody likes to go through difficult times in their business or their capital structure. So figuring out situations where, as you called it, there can be a win-win where we can come in, we can buy up the existing debt, we can help shepherd a company through a restructuring. We almost always provide new money during the bankruptcy so the company can continue to pay its bills on time and its payroll. In many cases, we provide exit financing for the company coming out of bankruptcy and money that they can use to revitalize operations. In many cases, these companies have CapEx that's been deferred for many years as they've been going through issues and tightening their belt in terms of spending money. So we can help them really recapitalize and then start to reinvest in the business. I think if you think about another situation that we've gotten pretty good at, we like to keep companies out of formal bankruptcy processes. It's very important because there's a certain negativity associated going through a prolonged, protracted fight in bankruptcy amongst different creditors. And so if we can find situations where we can consensually get all the creditors to agree to restructure a company, work with management to incent them to stay, come in and out of a process in a matter of weeks or months versus years. The suppliers, the customers, the management team, the employees all feel much better about the situation. And so it's an approach, and I'd say not all distressed investors approach it this way, but we do believe that approach is important for creating a situation that ultimately creates value, not only for ourselves and our investors, but also for all the stakeholders involved that touch the company directly or indirectly.
Sure, and that raises, it's interesting semantics that distressed is a negative, and there's an uninformed perspective that investors in this field profit from the difficulties that companies are in. That story you're telling about the win-win situation, and that you're actually interested in pulling companies out of a death spiral and having that situation emerge, it's not a picture that's probably well understood, and I wouldn't say in Australia understood well at all.
Yeah, and you're correct. And if you read many of the press accounts of people who traffic in this strategy, some of the descriptions are less than flattering about folks who do what we do. And I think what's important to realize is these situations are tremendously difficult for many of the stakeholders. Having a company liquidate if someone like us isn't involved, or go up for an auction at a time when they're under severe distress, it's difficult to see how any of those are value maximizing for employees, suppliers, customers, the company, any of the stakeholders, and certainly not credit investors like ourselves. And so having someone whose job it is to take company through bankruptcy and who's done that numerous times over and over, a team who's able to see positivity where others see negativity, where people, in our view, the difference between perceived risk in a company versus what we think actual risk is very different, and sometimes we think the actual risk is much less than the market's perception of it. And so we're absolutely looking for those opportunities where we can turn a business around. And I think turnaround might be a better moniker than distressed in many ways.
It's interesting, Paul, that ESG is so prominent now. Everything's seen through an ESG lens, and there's a really interesting story here with the S element of ESG that in Australia, in the US, all sorts of places, there can be real profound social impacts from bankruptcies, particularly where there's large regional employers. So are you finding that the S element of ESG, people are starting to look at the role you play, and are you gaining any ticks from an ESG perspective?
So the interesting thing is that ESG means different things to different people. And so if you spend time in the Nordics, you spend time in the US, you spend time in Southern Europe, in Australia, in Asia, it's defined differently for everyone. And so it's a bit challenging to think about it sometimes. But I will say that in Australia specifically, more people have been open to interpreting what we do with a view that it is socially responsible and has that view. So I think it's somewhat geographically specific in terms of how people, one, define it, and then two, how broad or narrow they're willing to use in that definition.
What about, you mentioned it before, coronavirus as a stressor. So does something like that, and this is a big one obviously and unfolding as we speak, but does that provide the kind of environment that a distressed debt investor likes to see in the sense of more candidates emerging, more of your universe possibly coming through your filters as a live situation?
So I'd answer that in a couple different ways. One, we never like to see things that cause pain or those kind of fatalities to anyone result in positivity for us, just as a view, which is kind of it feels a little bit unseemly in the end. So I would say no one in our business is hoping for things like that, pandemics or epidemics. But I do think when you think about what causes things like GFCs or recessions, in many cases they're things that might be obvious in the rearview mirror, but are very difficult to have predicted. There are those that thought the mortgage issues back in 2005, 6, 7 would lead to what happened in 2008, but there's a handful of them, right, that actually were there. So most people didn't see that coming. And most people didn't see this coming in many ways. It certainly wasn't a topic of conversation pre-end of December or early January. So far, it's been limited to broad sell-offs in the equity markets. I think as we look at it unfolding, it seems clear to cleared to be slowing down many parts of the economy pretty materially, far beyond Q1, given that we're sitting here almost at March 1 today, so the back half of Q1. And I think there was some reporting out of Goldman Sachs this morning that sort of said best case, flat profits for growth in the U.S. So it's kind of some big macro implications to what's going on now. So it certainly could have a more global slowdown effect that could create opportunities. I think what's most important for us, though, is that, again, I think that would be more limited to creating an opportunity set for the first time in a long time in large cap distress, which I think those investors will have a role to play in that. Will it increase our opportunity set in small cap? Of course, it will, but we don't need things like that to happen in smaller companies to generate opportunity. It just increases the opportunity set we're already seeing by some level.
Just the linkages of global trade and the supply chain dynamics, would it be true to think that your filters are really starting to set off signals?
It is. So far, we've seen it mostly in Europe, and I think there's still some legacy impact, particularly in some of the industrialized part of Northern Europe, Germany, that supply into China, where you're seeing issues. There are absolutely, as you say, supply chain issues, particularly around shipping and any goods and services that are shipped, that are starting to come into both items we have on our shopping list in terms of companies we've been following, looking for good entry points. We aren't seeing it much in our portfolio companies yet because we don't have a tremendous exposure to Asia or to Europe in most of what we're doing. But I do think it's prudent to think there'll be a trickle-on effect into some of those portfolio companies as well in some of our strategy.
Coming back to the way that investors should view distressed credit, how do you position it, particularly in a low interest rate environment? Is it greater return potential, a diversifier, a source of income, reduction in portfolio volatility at the overall level, or a combination of all?
Yeah, I think it's really almost its own animal in terms of how you think about it. And there are people who put it in a private equity asset class. There are people who think of it as part of their distressed allocation if they're sophisticated enough. We've had people put it in fixed income allocation. So it's almost situation specific for the end investor. But I think when you step back and you think about what distressed debt investing is, it's really about generating a risk return paradigm that is different than any other asset class, in that we take credit risk, which should have some limited downside protection, and try to make equity-like returns. So that asymmetry of having the ability to try to get returns close to or better than equity while still protecting your downside is what we're looking for. And you really need an inefficient or opaque market to do that in. Very actively traded efficient markets don't provide asymmetric returns as frequently as these do. So we try to think about it in terms of that risk return paradigm.
Equity-like returns, I mean, we won't talk numbers about what that is, but how do you balance that risk return when you're looking for equity type returns, and in the risk in this particular vehicle or this area of the credit asset class, what kind of returns compensate for the risk being borne?
So if you think about just simplistically an investment that's having an issue, there's an operational issue, there's a financial issue, there's a macro sector issue, you're going to take it through a bankruptcy process. There's a tremendous amount of work to be done in that. There are a lot of moving parts. It's certainly a situation, just by its name, if it's distressed, there are issues going on. Everything we look at is broken in some way or another. And there's risk inherent in doing all that. And so we try to analyze specific situations and look at them and say, okay, fundamentally, is this a good industry, a good business that has a reason to exist, that has sustainable margins, that will be around for decades, that we can make a bet on? And can we then, underneath that, identify specific issues that need to be fixed that are causing the distress, and believe that we can either influence those things or that they're going to right themselves over time, given some external factors that we can spend time diligencing. And our diligence process is months long. So it all starts with the view that there isn't risk in the industry that we believe is material, or the business itself. And the risks we are taking are ones that we feel are isolated, identified, knowable, and we've got a 100-day plan to go fix. The restructuring piece of it, the fixing the right side of the balance sheet, that's the part that we've done hundreds of times. So that's almost somewhat generic, although there are some situational specific parts to it.
Mm-hmm.
So that's how we think of it.
Paul, you mentioned before that you don't have a great deal of exposure to Asia. What about Australia in that picture? Do we have in Australia a functioning distressed credit market? And is there any likelihood that you would make investments in Australia at some stage?
So historically, there has been a market here for it. If you go back to the GFC, one of the most well-known deals at that time was Centro, and so there was a vibrant distressed market, so to speak, back as there was in many geographies in 2008, 2009.
It was a skill people had to learn quickly.
Yes, and so but you all have had a tremendous boom economy for the 10 years coming out of that, not unlike the United States, and so there in terms of large cap distressed hasn't been much to do here. There's been some smaller opportunities in some of the retailers here for various reasons, but it hasn't been anywhere near as robust a market for us as America, the United States, Canada, and Europe. What I would say on that point, though, is for what's important to a distressed debt investor is jurisdictional regimes in terms of legal processes. And so you try to find places where creditors' rights are respected. In other words, creditors are senior to equity in a restructuring process. They come first in terms of repayment. And the nice thing about the Australian market is your schemes of arrangement are perhaps the most protective of secured creditors anywhere in the world. So people who do what we do in terms of this strategy would love to invest here simply because your restructuring process is very protective of creditors.
Looking at Australian investors, getting their heads around credit has been a process of getting them to understand that, look, these are often listed names that you know well, and you possibly have the equity. Just consider the other side, the credit side. But it sounds like from what you're saying that this is a potential foray into unlisted and private industry, and that's a whole new world of exposure.
Absolutely right. And again, I'd make the differentiation between the large cap end of the distressed strategy. There are folks who focus on public distressed opportunities. We think the market is much more interesting in the private space, where companies are unlisted, they're private, they're almost always owned by a private equity firm. They require private side information, a confidentiality agreement signed with the company in order to do diligence. So it's very difficult to access that market, even for someone that does what we do. And I think what's interesting about it is it requires a pretty specialized skill set that you develop over time to invest in that market in those types of companies.
Is this a retail investment vehicle in the US? Is there appetite among retail investors for it? And if so, is that going to come to Australia?
Yeah. So I think globally speaking, the distressed asset class has a lot of different avenues, whether it's a big fund or a small fund or a middle-sized manager. There are lots of different avenues to invest in it. And if you look at investors that have invested in this space historically, it's everything from retail to high net worth to institutions to endowment and foundations to pensions and corporate. So I think the market has gotten sophisticated enough in alternatives, just broadly speaking, including distressed, that globally, and I think here in Australia as well, it's really open to all avenues.
And in a lower for longer world that's potentially going to be exacerbated by coronavirus, it may swim onto the radar of even more investors.
It absolutely could be.
Thank you, Paul.
Thanks
Appreciate
very much.
your time.
Thank you.